Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Today we're doing a deep dive into a really fascinating document, Markel's 2011 annual report. We've also got some discussion questions that help unpack it. And it's all about how a company navigates a truly turbulent year. Now you might be thinking, why 2011? That feels like a lifetime ago. But here's where it gets particularly compelling. This wasn't just, any year. We're talking about a global economy still reeling from the shockwaves of the 2008 financial crisis. Daily headlines were just screaming about European debt, persistent unemployment, a housing market that just wouldn't find its footing. And as if that wasn't enough, for Markel specifically, it was a year of record-setting natural catastrophes.
It's absolutely fascinating to watch how Markel handled this. They started as a small U.S. specialty insurer, but by 2011, they'd evolved into this diverse financial holding company. And they were facing these just immense headwinds. So this deep dive, what we'll do is extract how they didn't just survive, but actually managed to report record revenues and book value per share amidst all that chaos. We'll try to uncover the kind of unconventional principles and that unique resilience that guided them through what they themselves called a challenging year.
Yeah, exactly. Our mission today is to unpack the core identity, those shrewd strategic moves, and maybe even the unique cultural DNA that allowed Markel to not just weather the storm, but to make, and this is their phrase, tremendous overall progress during a time when so many businesses were just struggling to stay afloat. Hopefully you'll walk away with some powerful lessons on long-term thinking, adaptable resilience, and the often underestimated power of trust. Almost magical, as they put it. So let's really set the scene for 2011. The report itself, it starts by reaffirming a goal from way back in their first public report in 1986. Basically, to give you an overview of the corporation, our 2011 results, and our plans and goals for the future. Standard stuff, right? But what's interesting is just the sheer physical growth of that report. It went from, 38 pages to 138, which reflects not just, immense regulatory changes, but also the company's own wonderful growth over those decades.
Indeed. And they didn't pull any punches in the report. They described 2011 explicitly as a challenging year. I mean, for the first time since Hurricane Katrina back in 2005, Markel actually reported an underwriting loss. And this wasn't down to poor management or anything. It was directly attributable to this unprecedented series of record-setting catastrophes that year. You're talking devastating floods in Australia and Thailand, powerful earthquakes in New Zealand and Japan, and then just a relentless barrage of tornadoes and hurricanes across the U.S. It was quite the year.
And the numbers really back that story up, don't they? Their core insurance operations took a significant hit. You mentioned the underwriting loss. Their overall combined ratio was 102%. That's up quite a bit from 97% in 2010. And just a quick reminder for you, if you're less familiar, the combined ratio is key in insurance. It measures premiums earned against claims and expenses paid out. So 102% means for every dollar they collected in premiums, they paid out $1.02 in claims and costs. An underwriting loss, that's got to sting.
It absolutely does. It's a tough position for an insurer. Yet, here's the paradox. Despite that significant underwriting loss, the company still reported record total operating revenues, $2.6 billion, which was an impressive 18% increase from 2010. And maybe even more remarkably, they hit a new record high for book value per share, $352.10. That's an 8% jump year over year.
Okay, so that immediately raises a critical question, right? For you listening, how on earth did they manage to grow financial value, hit record metrics in such a brutally difficult environment, especially when their core insurance business took that direct hit?
Well, it points directly to a unique strategy, doesn't it? Something multifaceted that went far beyond just underwriting performance alone. And a deeply ingrained long-term perspective. They acknowledge these results were, quote, small advances and lower rates of increase than we would like. Very modest language. But they add they were nonetheless pleased given the year's challenges. What this signals is this underlying resilience built on diverse foundations, not just relying on a single profit engine.
Okay, let's unpack that resilience piece deeper, because the report then pivots, interestingly, to something almost intangible, yet profoundly important: trust. And here's where it gets particularly compelling, I think. In a year marked by global financial turmoil, widespread suspicion, Markel highlights trust, literally in all caps in the report, as a key reason for their historical success, both internally and externally.
The letter from management describes an almost magical internal environment. That's their word, magical.
Yeah.
It's this place where mutual commitment and trust mean individual skills are magnified and the business becomes something more than just the sum of its parts. This intangible essence, as they call it, is explicitly credited as the secret behind the decades of success at Markel. But here's the tangible bit, right? This internal trust wasn't just a nice phrase for the annual report. It likely enabled faster decision-making during that crisis year, probably reduced internal friction when resources were stretched thin, and allowed them to pivot quickly where maybe competitors, perhaps mired in suspicion or bureaucracy, might have moved much more slowly. It's about operationalizing that intangible asset.
That's a powerful idea. An internal culture that actually amplifies individual strengths. But did the report draw a contrast between this internal trust and the broader economic climate of 2011?
Yeah.
It must have felt like a very different world outside their walls back then.
Oh, absolutely. Starkly different. The report paints a really bleak picture of the broader economy post-2008. It draws the sharp contrast with Markel's internal culture. So before 2008, the general vibe was, systemic goodwill and trust. People generally trusted mortgage applications, house values, bank deposits, all that stuff. But as the letter bluntly states, in many cases, the trust was violated. We all know that story. So by 2011, it was the opposite environment, what they actually called a desert period of skepticism and distrust. And this fundamental breakdown, it had massive ripple effects. Banks became incredibly cautious with lending. Investors, consumers, everyone approached transactions with a jaundiced eye, as they put it. And the result? Fewer deals, slower deals across the whole economy, creating a slower, more ponderous, and less vibrant economic environment.
So what does this all mean for you listening in? Whether you're leading a team, analyzing a market, or just, navigating daily life. This idea of trust, or the profound lack of it, isn't just some abstract concept for economists, is it? Markel's narrative shows us it fundamentally impacts the speed, the velocity, the efficiency of business, their ability to somehow foster and maintain this internal trust while the outside world was steeped in skepticism. Well, that wasn't just a nice to have. It looks like it was a significant differentiator. It allowed them to operate with agility when maybe others were paralyzed by distrust. Okay, so moving on from the why and the how of trust, let's dive into the what's. Specifically, the engines driving Markel's financial resilience. The company clearly evolved significantly from that small, newly public U.S. specialty insurance company 2 decades earlier to a diverse financial holding company with global insurance, investment, and Markel Ventures operations. That diversification seems crucial.
Oh, it's absolutely key to understanding their 2011 performance. Let's break down those engines. First, the insurance operations. The international division, which had gross premiums of about $825 million, it bore the biggest brunt of the record catastrophe year, as they said, resulting in that really challenging 116% combined ratio. Ouch. Now, what's crucial here isn't just the loss itself, but their reaction. They explicitly stated they would walk away from many catastrophe-exposed risks if the market wasn't willing to pay what they thought was an appropriate price. This isn't just cutting losses short-term. It's a very deliberate, counter-cyclical, long-term play. They're showing pricing discipline, basically betting that future market corrections would make these risks profitable again later. But at the same time, while pulling back selectively, they were expanding geographically, opening new offices in Rotterdam, Sweden, Spain, Hong Kong, Beijing. So it's this dual strategy discipline where it's unprofitable now, but expand the footprint for future growth opportunities.
Interesting. So while international was navigating those really choppy waters, how did their other big insurance segments like specialty and excess and surplus, how did they fare? Similar pressures, different opportunities.
Well, specialty insurance saw about $572 million in gross premiums and a 109% combined ratio. Still an underwriting loss, but less severe than international. This segment included the first full year of their first comp acquisition, which was significant. It brought in $227 million in premium and, importantly, new leadership talent. They were also adding some interesting new niche programs, things like wine insurance and garden center insurance, very specialized. The excess and surplus division, or E&S, however, performed relatively better. Its combined ratio was lower at 86%, so an underwriting profit there. Premiums were slightly lower, though. A key factor they mentioned was their One Markel business transformation program, which sounds a bit corporate speak maybe, but it was specifically aimed at being easier to do business with. Things like streamlining policy issuance, improving broker interfaces, practical stuff. And the report noted E&S is often the tail end of the whip in market cycles. They were hinting pretty clearly at expected price improvements coming down the pike because those huge industry-wide cat losses, about $105 billion total, or making the entire industry unprofitable. So they were positioning E&S for that inevitable market hardening.
Right. So the whole insurance side was actively adapting, repositioning for future cycles. Very dynamic. But then there's Markel Ventures. You mentioned that diversification saw significant growth in 2011. Can you explain what exactly Markel Ventures is and how did these non-insurance operations contribute to Markel's overall resilience that year?
Yeah, Markel Ventures is essentially their arm for owning and operating industrial and service businesses. It's a huge part of their diversification strategy. And in 2011, it showed really remarkable growth. Revenue shot up 89% to $351 million. And their core operating profit metric, EBITDA, earnings before interest, taxes, depreciation, and amortization, that was up an impressive 83% to $37.3 million. What's insightful, I think, is the type of businesses they were acquiring. Key deals included Partner MD, which is a concierge medical practice, and a controlling interest in Weldship, which provides equipment for the industrial gas industry. These are businesses often less correlated with insurance cycles, certainly less correlated with natural catastrophes, so they offer a more stable, diversified income stream. Markel Ventures really embodies their core belief that a permanent capital base and long-term business focus create the best economic outcome over time. And they were actively out there looking for more profitable, often non-cyclical businesses to acquire. It provided a vital counterweight to the insurance sector's volatility in 2011.
That makes sense, building those complementary income streams strategically. Okay, so insurance adapting, ventures growing strong. That brings us to the third critical pillar, their investment portfolio. How did their investment approach fare in those pretty unsettled financial markets? What were the key decisions there?
Well, their total investment return was a respectable 6.5% in 2011. Not spectacular, but solid given the environment. That broke down into 7.6% for fixed income bonds and 3.8% for equities, so stocks. A really crucial point highlighted in the report is their proactive caution about interest rates. They believed rates were unsustainably low. They actually said rates were something other than zero, which is a nice way of putting it. And they expected future increases. So to protect their balance sheet from potential big price declines in their bond portfolio if rates did rise, they intentionally held shorter-term bonds, even though, they admitted, it might pinch current investment income a bit. That was a shrewd move, looking back. Shorter-term bonds are less sensitive to interest rate hikes. So if rates rose, their bond portfolio wouldn't take the same kind of hit as a portfolio stuck with long-term bonds. It's a classic example of prioritizing long-term protection over maximizing short-term yield.
And what about their equity strategy, given their focus on value and that long-term thinking we keep coming back to?
For equities, yeah, they stuck rigorously to their historical and unchanging four-point discipline. They laid it out clearly. 1, seek profitable businesses with good returns on capital. 2, make sure they're led by honest and talented managers. 3, look for reinvestment opportunities and capital discipline within those businesses. And 4, acquire them only at fair prices. This discipline just runs through everything they seem to do. They also highlighted a really significant advantage, managing investments in-house. Lower costs, better tax efficiency. And they gave this compelling example to illustrate it. Imagine a spectacular 20% gross return. If you achieve that via an alternative asset manager, after typical fees and taxes, you might only net $9.36. But if Markel managed it internally, that same 20% gross return could net $19.20. Almost double. That's due to significantly lower costs and much better tax management. It shows a deep understanding of optimizing that returns for shareholders, not just chasing gross returns.
Okay, this brings us squarely to Markel's leadership and their vision for the future. In a year they described as having modest financial progress, but tremendous overall progress. What specific steps did management take? And what was their overarching long-term game plan, especially maybe in contrast to the broader corporate landscape at the time?
Well, one striking detail from the report, and it really speaks volumes about their culture, I think, is how leaders should align their own interests directly with shareholders. The actual signers of the letter, so the top executives, received no bonuses or salary increases for 2011. Flat out, there was only one exception mentioned related to a prior employment agreement. And they explicitly presented this as demonstrating appropriate leadership and commitment. They positioned it as a direct contrast to what they called less than wonderful corporate behavior seen elsewhere during that tumultuous post-crisis period. It's a very clear signal of integrity and shared sacrifice.
Yeah, that commitment to not taking bonuses, especially in a tough year, that is a powerful signal of alignment. Definitely stands out. But beyond that sort of ethical stance, how did the report detail their practical, actionable strategy for actually creating value, especially when financial progress was admittedly modest?
Right. They didn't just talk ethics. They clearly outlined 4 main tools they intended to use consistently to grow and build shareholder value. It was very practical. One, reinvesting in organic opportunities within their existing insurance operations, growing from within. Two, acquiring additional insurance businesses strategically when the price and fit were right. Three, acquiring controlling interests in good businesses, public or private, through Markel Ventures, that diversification engine again. And four, repurchasing their own stock when they felt it was favorably priced and they had excess capital. And the key takeaway the report emphasizes is that in 2011, despite the challenges, they engaged in all four activities. So this wasn't just some theoretical plan on paper, it was a proactive, multifaceted approach to allocating capital that they were actively pursuing, even in a tough year. It demonstrated they were constantly building for the future across all those strategic pillars.
It really sounds like they're absolutely playing the long game, doesn't it? Not just talking about it, but actively executing it. And the report culminates in this powerful statement, saying they are building one of the great companies of the world, marked by, quote, unquestioned financial success and being an exemplar of how business should be done. I mean, that's a pretty bold vision for any company, let alone one navigating the kind of challenges they faced back in 2011.
Wow, so what a deep dive that was into Markel's 2011 annual report. We've really seen how a company can not only navigate a, frankly, brutal global economy and a year packed with natural disasters, but also proactively lay the groundwork for future growth. Through this almost countercultural emphasis on trust, a diversified and strategically managed business model, and a really disciplined long-term approach to allocating capital.
It really does emphasize that true resilience isn't just about passively weathering storms, is it? It's about actively adapting and building throughout the cycle. From refining their insurance underwriting and strategically expanding into new markets even while pulling back elsewhere, to growing Markel Ventures with a clear eye for those non-correlated businesses and maintaining that disciplined, protective investment approach. Their actions in 2011 really provided a tangible blueprint for enduring success. It wasn't just survival mode, it was clearly a strategic build.
So what does this all mean for you listening in? Whether you're managing a team, making an investment decision, or maybe just trying to understand the principles that drive enduring success. The Markel story, I think, challenges us to look beyond just the immediate financial metrics, doesn't it? To consider what truly underpins long-term value creation. Is it only about the numbers on the balance sheet, or is it also about those less tangible assets, like trust, like integrity, like strategic patience, and having a clear, unwavering, long-term vision that really guides every capital allocation decision?
Yeah, and maybe this raises an important question for right now. In our incredibly fast-paced world, where short-term results often seem to dominate everything quarterly reports, market sentiment, can kind of foundational trust and that patient, multi-pronged growth strategy that Markle demonstrated back then, can that still be the ultimate, perhaps even unconventional competitive advantage for businesses aiming for decades of success, not just quarters? Definitely something to ponder as you look at the companies and opportunities shaping our economic landscape today.